Welcome to the deep dive video update. This is one of the last videos that I do over the weekend where I go through all the charts that I've been looking at throughout the week and those that I either stopped using at some point or didn't use at all. I put them into this video because sometimes we can get some additional insight by looking at these charts. Also, there are other charts that are unique just to this particular video that we use more for informational purposes. This is being prepared for Monday, June 23rd. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. The first chart that we see here is a chart of the VIX, long-term range. Now, this past week, as stocks have been a bit under pressure, we've gone back above 20 with the VIX on the daily side. This looks at the longer-term range, and here with this red line, this means that we're still below 20 for the most part, and we've actually been rolling over a little bit longer term. When we're in this lower range, that's typically more positive for stocks. If we go up into the upper range, that would be much more negative. And we want to keep an eye on the speed of the VIX. And even though it's been going back up, it's not really going up with a lot of conviction right now. So we're not getting an extreme positive or negative reading from this chart. We look at the VIX and then do a correlation of the VIX to the S&P. Even though this has been going back up, we're not at the dashed line yet. That's when we really pay attention to this chart. And this is actually more positive. This looks at a ratio between the VIX and then the volatility of the VIX, or VVIX. As this has been declining, that's been more positive for stocks, and that's still continuing. Then another fear gauge is the Ulcer Index, where it continues to be below its moving average, showing that there's not a lot of fear, according to this chart, right now anyway. We look at a ratio between the VIX, that's stocks, and the MOVE Index, which are bonds. We're a little bit concerned because the red line's starting to turn back up just a little bit. It's been more positive as this red line's been coming down. So we just want to keep an eye on this one. And we look at a ratio between large caps and small caps, not really getting any insight. This ratio continues to pretty much chop along sideways. Then for informational purposes, we can see that we're up over 70% from the October 2022 low. We're up over 45% from the October 2023 low. And we're up almost 23.5% from the April 7th, 2025 low. We're also above the 200-day simple moving average. Coming down a little bit here, but still up 2.64% above the 200-day simple moving average. We're above all of the anchored moving averages here. These are either tied to a high or a low. Now, if we do start to see some weakness coming into the market, we'll be watching one of these lines to see if they end up providing support. And we look at advanced decline lines, and I haven't been showing them all that much because we're not getting an awful lot of insight right now as the S&P has not been trending. In the middle area here is a cumulative advanced decline line for the S&P based on price, and just kind of going sideways for the most part, seeing a little bit of recent weakness. And then we have a cumulative advanced decline line for the S&P based on volume. This is actually holding up a little bit better. It actually broke out and set a new all-time high, but since has been pulling back a bit. But really nothing all that insightful that we're getting from this chart. Then we look at the NYSE advanced decline line, and this is still holding up fairly well. And we look at a cumulative advanced decline line for the NYSE. And then down below, we see another NYSE advanced decline line. And again, some weakness has been coming in lately, but nothing, at least with a lot of conviction to this point. Then we break it out based on price and volume for stocks on the NYSE. A little bit of weakness coming in, both based on price and volume. Then we look at some different sector studies. Discretionary to staples, the weighted version of this study, pretty much going sideways, and then even the equal weight is also going sideways, not showing a lot of strength. This has been one of the weaker areas lately, and this includes Tesla, Amazon. We want this to really do well and start to perform better. It's not necessarily breaking down, but it's not breaking out at this time. Seeing a little bit of improvement with tech to utilities here, as well as biotech to healthcare. But when we look at hotels to utilities, we're actually drifting down a little bit and seeing some weakness. We just keep an eye on this and see if anything's really speaking to us right now. And it hasn't really been giving us any additional insight. So I haven't been showing this chart. And just kind of chopping along sideways when we look at the bellwethers with semiconductors, home builders, the transports, retail, even regional banks. Not showing a lot of strength, but not necessarily a lot of weakness either. We're still above all of the moving averages here with the large cap growth ETF. And the longer we stay above that, the more these moving averages will continue to improve. And this is actually kind of counterintuitive. With this ratio going down, that's more positive. That means that value is underperforming tech, which is the major part of growth. And momentum stocks have been holding up better as stocks were coming down in late March and into April. This was actually going up. And as we've been under a little bit of pressure with the S&P and not trending right now, we're seeing this chart show a little bit of an improvement. Then we have technical alerts, and these start with Monday session and go all the way to Friday. And usually when I show it this way, we just look, what's the majority of the color? Is it red or green here? And we saw some weakness later in the day on Friday. That's why you see more red. But on positive days, earlier in the day, we were looking a lot better, and so we saw a lot more green. Then we look at 6 different indexes and say, okay, which one is best from a technical analysis score perspective on a scale of 0 to 100? Not looking all that great, but still coming in first place is the ETF for the QQQs, or the NASDAQ 100, coming in at 63.4. Again, not great, but this is still the best looking one. In second place is the NASDAQ itself, coming in at 52.8. In third place is the S&P 500 at 48.8. Then we have the Dow coming in at 20.6. It's been having a really hard time staying above its 200-day moving average. Then the mid caps not doing all that well, improving slightly, but still coming in at 13.9. And we're back up slightly into double digits again with the small caps. They've been giving us single digit readings for a while. They're coming in at 10.3. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then a short-term rainbow going from 10 periods up to 50 periods. Even though we've been pulling back and not really trending, most of the lines in this rainbow continue to go up. Now we're seeing some vulnerability with the short term with some other studies that I go through mainly in the daily video, but this is still holding up right here. But we'll keep an eye on those other charts, and then if we do start to come back down into the rainbow, we'll just keep an eye on that. But for right now, the 20 period moving average is what I use, and that's been providing support. As long as we're above that, the short-term trend is considered positive. If we end up closing down below that, that would turn the short-term trend to negative. Then we look at the advanced decline ratio based on price above. We are slightly below the midpoint, turning a little bit negative. But even though we've been declining, we're still above 0 based on volume. So that's still holding up for right now. Another rainbow from 50 periods up to 100 periods. We're still above all of the lines in this rainbow, and they're continuing to improve. The intermediate term trend, although showing a little bit of vulnerability, has been holding up a lot better, and this chart kind of bears that out. We're still well above the 50 period moving average, and that's what I use to determine the intermediate term trend. And then a little bit longer term is the 100 period moving average, and we're still well above that one as well. We're kind of been dealing with the 20 period moving average, and that at least is the initial level of support if we see more weakness. Then the boom indicator, it measures how far away are we from the 20, 50, and 200 period moving averages. We were really extreme as we were coming up out of the lows. We've worked a lot of that off now, and we're not seeing extreme readings with the 20 and the 50. We're declining a little bit from the 200, but we're still above zero, and that just means that we're above the 200-day moving average. Bollinger Bands coming down, but still above the midpoint here. And then another percentage type measurement, measuring from the October 2023 low to Friday's close, still looking pretty solid there. Also, I like to keep tabs on how much of a percentage loss have we when we start to retrace. And that can end up being quite handy, but it's not really all that useful right now. And the Connors RSI, we just look for extreme positive or negative readings here. On a daily basis, this thing bounces all over the place, but we don't see very many extreme positive or negative readings very often. Coming down and looking a little more negative, but again, this is the CMB composite, and I use it to determine when I only show it in the videos when we're above the black line or below the black line below. And then standard deviation, we really haven't been trending. We've been really leveling off lately as we really came up out of those April lows. And so we're not seeing a lot of movement with the S&P 500 right now. The S&P 500 on top, the S&P 100 in the middle, not really seeing any negative divergence currently. Point and figure chart didn't have enough of an up or downward move to draw any new X's or O's, but this is still hanging out, looking pretty good. We're still working at an ascending triple top breakout that was generated back on June 6th. The mass index not close to the red dash line or the blue line, so there's been no need to show this. And we were actually trying to generate a praying bottom fisher buy signal here, but that didn't last very long as stocks have started to go sideways. So we dropped back down below the red line, so that buy signal has now gone away. A long-term rainbow, still above all the lines here. They continue to improve. Its price remains above those lines. The long-term oscillator called a special K, still below the red line here. We're negative on the daily side. We continue to be above the red line on the weekly chart. And the weekly chart of the S&P on top, the German DAX, we're seeing that they're coming back into more of a stronger correlation as the German DAX has been pulling back a little bit with the S&P holding up a little bit better. And since it was outperforming, we saw the correlation really breaking down. Now they could be getting a little bit closer in line with each other. Then the Ichimoku cloud. No need to show this because we're above the cloud, and for the most part, we're still positive. We're seeing the blue line above the red line. That's positive. And we're seeing the green line showing a little bit of weakness. That's short term. But for the most part, this has been holding up, and we're still above the clouds here. Some broad market measures. This is the VIXen, which is the VIX for the NASDAQ 100. It's also been going up a little bit here as both the NASDAQ 100 and S&P have been showing a little bit of increase of fear coming in. And we look at a growth to value ratio in the middle compared to the S&P on top, and they're neutral right now. We're not really seeing a strong correlation. We keep an eye on the Dow, which is the black line, and the transports, which continue to underperform the Dow itself. The bank ETF just kind of meandering around below its 200-day moving average, but still above its 50-day moving average. And keeping an eye on the regional banks, which are smaller banks, and comparing them on a ratio basis with the financial sector, not showing any strength, but not an awful lot of weakness lately. The retail sector continues to underperform the S&P, even though it's above its 200-day moving average here and still above 50 with the RSI. Then an energy to 10-year bond ratio. Now, energy's been seeing some real improvement with the geopolitical escalation that we're seeing between Israel and Iran. And this has been coming back up here, but when you look at the bigger picture, going back to 2023, we are pretty much range bound with this overall ratio. Gold to the S&P 500, we're still under this yellow line and we've been retreating. And it's not that gold is really coming down. It's gold is kind of going sideways now as the S&P has been going sideways. So we haven't seen really big changes with this overall ratio. Emerging markets compared to developed markets still continue to underperform. And then we look at the 10-year yield in the US, subtracting the German 10-year yield. That gives us a line on the top. Then we plot the US dollar index, and we're seeing this correlation really starting to drop off here. Typically, this correlation will be pretty strong, but we're seeing a lot of geopolitical maneuvering, a lot of uncertainty about the trade wars and the tariffs, and lately this relationship has actually started to drop off lately. Here's the German DAX, which is still doing quite well. It's still in an uptrend, but it has retreated down to its 50-day moving average. Then we do a ratio of the S&P 500 to the German DAX, and this is actually starting to go back up, meaning lately the S&P 500 has been outperforming. But if you go back to the beginning of 2025, this is when we saw this ratio really coming down as German stocks were outperforming US stocks. The QQQs were still above the moving average here, which is a 20-period moving average. This is also providing support, and we're just about ready to see the 50-day moving average cross back above the 200-day moving average. We're getting close to seeing that with the NASDAQ 100 as well, which is the index for this QQQ ETF. And that would be more positive. And some rate of change charts, very long term, are declining a little bit with the 250 period rate of change. And then this goes all the way back to 1980. We're declining here, but we're still above zero longer term. Bonds, and I try to explain this, we're trying to get some insight as to what is the market thinking about inflation and interest rates. Now, and people can say whatever they want, whether they're economists or just have an opinion about things. What I like to follow is what's the market telling us, because that's really what we have to pay attention to. And this first chart is basically looking at cash to 3 to 7 year bonds. And when this is going up, that means that there's more uncertainty. They think the market thinks that interest rates are going to go up, and they're possibly worried about inflation. We've been just chopping around lately, not really showing any conviction. Then we do that same basic approach with TIPS, which are Treasury inflation protected securities. This is what folks get into when they're worried about inflation and interest rates. It has been coming back up a little bit lately, but we're still in a downtrend and just pretty much chopping sideways with this ratio. So this is suggesting there's not a lot of inflation or interest rate fears according to this chart, and seeing pretty much that same thing when we look at TIPS with 7 to 10 year bonds, just kind of meandering sideways lately. And we look at the long-term bond, which is in blue, and then the S&P, which is in red. The longer-term correlation had been dropping off. It's starting to improve. But when we look at the short-term correlation, we're pretty much neutral right now. Same idea here, except the long-term bond is in red, and we have the QQQs that are in black. We're turning back up, showing that the relationship between these two is starting to get a little bit stronger. But they had been going in opposite directions. But if we come back up to this minus 0.25 area, that's when it's considered to be neutral. And we keep an eye on the 2-year yield, which for the most part continues to go down with a series of lower highs here. And sometimes this provides some insight, but it really hasn't helped us all that much recently. Then we want to keep an eye on the 10 to the 3-month yield curve. We actually last week went inverted for 1 day, and we're really close here. And so we just want to keep an eye on that because we've come down, gone inverted, then we went back to being uninverted, then we came back down, went inverted. This is usually when we start a countdown to see, are we in fact going to go into a recession when it stops being inverted. But it doesn't seem to be stopping that for any length of time. It looks like we're improving, and then we come back down and go inverted again. Then this tries to compare U.S. stocks in the Eurozone with 3 to 7 year bonds in the U.S., and the Eurozone has really been outperforming, but lately starting to fall back with this ratio. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then we look at those percent of stocks that are above their 200-day simple moving average in the S&P. We use this like an oscillator to see if this is extreme positive or negative. We're not seeing that. We are still above 50. So this is usually the line between positive and negative if we're above 50. So we have been pulling back a little bit, but we're still hanging in there for right now. And we look at those stocks in the S&P above their 50-period moving average, which has been declining, but also still above 50. Then we keep an eye on the mid caps, which are also still above 50, and small caps, which are under 50. And that's been one of the weaker areas. In fact, probably the weakest area. That and the dollar have really been disappointing so far in 2025. Then this other ratio between the S&P and then staples, which this is what folks get into when it's turning more defensive. And then we see this ratio really going down like we saw at the end of 2021. And then we went into that bear market in 2022. When we were really coming down in March and into April, this ratio was really coming down as well as we were coming down with the S&P. But since then, it's been bouncing back up and really improving. I like to keep an eye on this chart, but for right now, it's actually looking more positive than negative. So thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.